90% of traders blow up their accounts. And here's the part nobody tells you. It's almost never because they picked bad trades. It's because of one number they never bothered to control. Stick with me, because once you see this number, you can't unsee it. If you've spent any time around trading, you've heard the statistic. Roughly 9 out of 10 traders end up losing money. It gets repeated so often that most people just shrug it off. But almost nobody stops to ask the obvious question. Why? Because here's the strange part. Most failed traders weren't reckless gamblers. A lot of them studied charts. They learned strategies. Some of them were even right about the market more often than they were wrong. And they still lost everything. So, if it's not about being right, what is it about? In this video, I'm going to walk you through the single most important rule in trading. A rule built on one simple number. We'll cover 3 things. First, the core concept, explained in plain English, no jargon. Second, a real side-by-side example with actual dollar amounts, so you can see exactly how this plays out. And third, the most common mistakes that quietly destroy accounts, and exactly how to avoid each one. By the end, you'll understand why 2 traders can use the same exact strategy, and one walks away wealthy, while the other goes broke. Let's get into it. Okay, let's start with the rule itself, because it's almost insultingly simple. The rule is this: never risk more than 1% of your total account on a single trade. That's it. 1%. It's often called the 1% rule, and it is the foundation that professional risk management is built on. Now, I know what you're thinking. 1%, that's nothing. How am I supposed to get rich? Risking 1%. And that reaction, that exact reaction, is the reason most people fail. So, let me reframe it for you, because there's a crucial detail hiding in that sentence. Risking 1% does not mean you can only buy 1% worth of stock. Those are 2 completely different things, and confusing them is mistake number 1. Risk is not the size of your position. Risk is how much money you actually lose if the trade goes against you. Let me show you what that means with numbers. Say you have a $10,000 account. 1% of that is $100. So your maximum acceptable loss on any single trade is $100. Not the amount you invest, the amount you're willing to lose. Now, how do you control your loss? With a stop loss, a predetermined price where you automatically exit the trade if it goes the wrong way. The stop loss is what turns risk from a vague feeling into an exact, controllable number. Here's the math that ties it all together. Let's say you want to buy a stock trading at $50 a share, and based on the chart, you decide that if it drops to $48, your trade idea is wrong, and you're out. That means your risk per share is $2. The difference between 50 and 48. Now you just divide. Your total allowed loss is $100. Your risk per share is $2. 100 divided by 2 equals 50. So you buy 50 shares. 50 shares at $50 is a $2,500 position. That's 25% of your account sitting in this one trade. But, and this is the whole point, because your stop loss caps your downside, you're still only risking $100, 1%, even though a quarter of your account is in the trade. That's the magic of separating position size from risk. You can take meaningful positions, you can still make real money, but you've put a hard ceiling on how much any single mistake can cost you. So, why does this one number matter so much? because of something called the math of drawdowns. And this is the part that should genuinely scare you into respecting this rule. When you lose money, you don't need to make the same percentage back to get even. You need to make more, a lot more. Lose 10% of your account, and you need an 11% gain just to break even. That's not so bad. But watch how fast it spirals. Lose 25%, and you now need a 33% gain to recover. Lose 50% of your account, and you need a 100% gain. You have to double your money just to get back to where you started. And if you lose 90%, you'd need a 900% return to break even. That's not a recovery. That's a fantasy. This is why the 1% rule exists. It's not about being timid. It's about making sure that no single trade and no string of bad trades can ever dig a hole so deep that you can't climb out of it. Because the traders who blow up aren't the ones who are wrong occasionally. Everyone is wrong sometimes. The ones who blow up are the ones who lose too much when they're wrong. All right, theory is nice, but let me make this real, because numbers tell the story better than I ever could. Meet two traders. We'll call them Trader A and Trader B. I want you to notice everything they have in common, because it's almost everything. They both start with the exact same amount, $10,000. They use the exact same strategy. They take the exact same trades at the exact same times. They even have the same win rate, let's say 50%. So they win half their trades and lose the other half, just like flipping a coin. Their skill is identical. There's only one difference between them. Trader A follows the 1% rule and risks $100 per trade. Trader B thinks that's too slow, so Trader B risks 10% per trade, $1,000 at a time. Same trades, different risk. That's the only variable. Let's see what happens. Now here's a truth about trading that beginners never plan for. Losing streaks are not rare. They are guaranteed. If you flip a coin a few hundred times, you will get a run of 7 tails in a row at some point. It's not bad luck. It's just statistics. And in trading, over hundreds of trades, a streak of 7 losses in a row is completely normal. It happens to everybody, even great traders. So let's put both of our traders through one of these very normal losing streaks. 7 losing trades in a row. Watch what happens to each account. Trader A, risking 1% each time, loses about 1% of a shrinking balance 7 times over. After 7 straight losses, Trader A's account sits at roughly $9,320. They're down about $680, under 7%. Annoying? Sure. A little frustrating? Absolutely. But Trader A barely felt it. They're completely fine. They can take the next 100 trades without breaking a sweat. Now Trader B, risking 10% each time, through the same 7 losses. 10% off, then 10% off the new, smaller balance, again and again. After 7 straight losses, Trader B's account is down to about $4,780. Let that sink in. The same losing streak, the same 7 trades that barely scratched Trader A, just wiped out more than half of Trader B's account. And remember the drawdown math from earlier? Trader B is now down 52%. To get back to that original $10,000, they don't need a 52% gain. They need a gain of over 109%. They have to more than double what's left just to undo the damage from a single, completely ordinary bad week. So what does Trader B do? This is where it gets tragic, because it's so predictable. Staring at a 52% loss, Trader B panics. They feel like they have to make it back fast. So they start risking even more, 20%, then going all in. And the next losing streak doesn't just hurt, it ends them. Meanwhile, Trader A, same strategy, same trades, same skill, just keeps calmly risking 1%, survives every storm, and is still standing when the winning trades eventually come. Here's the punchline, and I need you to really hear it. Trader B didn't lose because they were a bad trader. They lost because they sized their risk wrong. That's the entire difference. Same exact ability. Two completely different outcomes. One number. So, by now you understand the rule, and you've seen the proof. Let's talk about how people actually break it. Because knowing the rule and following it are two very different things. Here are the most common mistakes and exactly how to avoid each one. Mistake number 1, trading without a stop loss. This is the big one. Without a stop loss, you have no defined risk. You're just hoping. And hope is not a risk management strategy. A trade with no exit plan can lose 10%, 30%, or take your whole account if you freeze up and refuse to sell. The fix is simple. Never enter a trade until you know your exact exit price before you click buy. If you can't define where you're wrong, you're not ready to take the trade. Mistake number 2, moving your stop loss to avoid taking a loss. Picture it. The stock drops toward your stop, and instead of accepting the small planned loss, you tell yourself, it'll bounce back. I'll just give it a little more room. So you slide the stop lower. Now your 1% risk has quietly become a 3% risk, then a 5% risk. This is how a tiny, manageable loss turns into an account killer. The fix. Once a stop is set, it is set. You can move it to lock in profit, never to widen a loss. Mistake number 3, position sizing by emotion instead of math. This is risking more on trades you feel really good about. The problem is, the market doesn't care how confident you are, and your most confident trades are often your worst ones. The fix is to size every trade the same way, with the formula from earlier. Allowed loss divided by risk per share equals your position size. Take the feelings out of it and let the math decide. Mistake number 4, revenge trading. You take a loss, you get angry, and you immediately jump into a bigger, sloppier trade to win it back. This is the exact trap that finished off Trader B. Trying to recover a loss quickly is how a small loss becomes a catastrophe. The fix. Treat every trade as completely independent. Your last trade has nothing to do with your next one. If you feel that urge to get even with the market, step away from the screen. The market will still be there tomorrow. Mistake number 5, confusing a big position with big risk, or thinking the rule limits your upside. Some beginners hear 1% and assume they can never make real money. Go back to our example. Trader A had 25% of their account in a single trade and still only risked 1%. The rule doesn't shrink your positions. It controls your losses while leaving your gains wide open. Your winners can run as far as the market lets them. The fix is just to remember. The 1% rule is a cap on your downside, never a cap on your upside. Avoid those 5, and you've already separated yourself from the vast majority of people who quietly lose their accounts every single year. Notice something about all 5 of these. None of them require you to be smarter or to predict the market better. They just require discipline. And that's genuinely good news, because discipline is something anyone can learn. Now, if this clicked for you, if you're starting to see that survival comes before profit, then you're going to want the rest of this series, because we go deep on capital preservation. How to set smart stop losses, how to scale into winners, and how to build a plan that keeps you in the game for years. So go ahead and subscribe and turn on notifications so you don't miss the next one. And to make this dead simple to put into practice, I've linked a free position size calculator and a risk management spreadsheet down in the description. Just plug in your account size, your entry, and your stop, and it tells you exactly how many shares to buy to stay inside your 1%. It does all the math from this video for you, so there's no excuse not to start using it on your very next trade. So let's bring it all home with the one idea I want you to walk away with. Trading isn't won by the person who's right the most. It's won by the person who's still standing. The 90% who fail didn't lose because they couldn't pick a good trade. They lost because they let a single bad trade or a single bad streak cost them too much. The 1% rule is what makes sure that can never happen to you. Protect your capital first, and the profits take care of themselves. Master your risk, and you've already beaten 90% of the people who never bothered to try. Quick note before you go. This video is for educational purposes only and isn't financial advice. Always do your own research before risking real money. I'll see you in the next one. And that's a wrap on today's topic. If you found this helpful, be sure to hit like and subscribe so you never miss a lesson. Have a question about what we covered today? Drop it in the comments below. I'll be answering the best ones. If you want to dive even deeper, click on this next video right here, where we explore next topic. Thanks for learning with me today, and I'll see you in the next one.